In the last class, we looked at formation of a company, from the beginning of a company to who has the right to form a company to who has the capacity to form a company. We looked at the types of company by owners, liability, and by ownership, talking about limited liability company by shares, by guarantee, and unlimited company. We have private companies and public companies. We're able to look at differences between private company and public company. We looked at share capital, okay, and we looked at quoted companies, okay, and then we're also able to explain the way with which the account of a company is prepared. So basically, in this class, we are going to be looking at preparation of accounts for a company, and then we're also going to be looking at what illustrations. We've looked at some of the notes in the first class, but we're going to be looking at that again to help us understand how to prepare the income statement and the balance sheet for companies. We have other statements that companies will usually require, from the value-added statements to cash flow statements, okay, to 5-year financial statement. I already explained that in our previous classes, but our course of study is to prepare company's income statement, also known as the company's trading profit and loss account, or company's comprehensive income statement, and then to prepare the company's balance sheet, also known as company's statement of financial position. So let's look at it. We have accounting for companies. So I already explained that the accounting for companies are prepared in accordance with the double entry principle, and then accounting procedures together with the international standards and local standards, as well as whatever guideline has been published from time to time on the affairs or activities of the company or preparation. So basically, we have the double entry principles, accounting procedures, standards, local and international. Because Nigeria has a standard, countries have their standards, but we have the international standards as published from time to time. So now we have the company income statement. Okay, the company income statement is a statement prepared to show the profit or loss made for a particular period or year of reporting. So basically what we're saying is that the company income statement, also called the comprehensive income statement, okay, is prepared to know what the company made in terms of profit or loss for a particular period. So, but this varies from what? Industry to industry, because the items that signify the income vary from industry to industry. You know, the income generating items in the bank is different from the income generating item in a petroleum marketing company, is different from the income generating item in the real estate company. So we have it varying from industry to industry, but the onus is on you to be able to identify what the income item is and then treat it accordingly. Your expenses are generally the same, salaries, wages, and all that. But the income item, once you're able to identify the income item for the company based on the industry that you have it in, then it makes the work easy. So basically, the income statement shows your income against your expenses for a particular period. Okay, so now the company income statement from industry to industry. Let's look at financial service. Taking commercial bank as an example, let's say GTB. What are their major income or earning items? For instance, you have interest charge on loans. What do banks do? They get deposit from you. Okay, from the deposit they get from you, they give it out as loan to other people and then charge interest. The interest on it is an income to them. Okay, then they have SMS charges. They charge you for SMSs. If you go to the bank to print statement, they charge you for that. They charge you for account maintenance and all that. So basically, this is how the income or the earnings of the bank looks like. So once you're able to identify all these items, you are well and good with with the income generating items. Let's look at oil and gas, petroleum marketing. Let's say Petrol Limited. What do? They sell PMS. PMS is your fuel. AGO, your diesel. DPK, that's your kerosene. So you have a typical trading and profit and loss account in that scenario. Telecoms, what do? They sell SIM packs. Those are their income items. They sell mobile phones sometimes. They sell data. They sell core credits. They charge interest when you borrow credits. They charge interest when you borrow data. So these are some of the income items for telecommunications. Farming. Let's say Kerex Cooked Rice Farm. What do? When they produce the rice, they sell. So the crop is more like the rice that they're selling. The next one is hospitality, Eco Hotel and Suite, for instance. Okay, how do they make their money? Accommodation. When you go there to lodge, you pay for accommodation. They sell food and drinks to you. They rent out conference room. They rent out halls. Some musicians sometimes do shows in some of these halls. Okay, and then we have transportation. Let's say ABC Transport Limited. What do? They sell tickets, cargo, transport, bus hires. These are some of the income item for what? For the transportation business. So the idea is that once you're able to identify the industry of the company, you should be able to tell the income items of the company based on the service of the company. So with that, your income statement is halfway done. So let's look at how the income statement looks like. Remember, this is a trading scenario. So we've already taught us how to prepare trading profit and loss account. We have a class for that. You can go back to that class to also understand it. But there it is. You have turnover, which is your sales. Note 1. Note 1 is to tell you how you got your turnover. So what do you have? Turnover, note 1. So sales is this. Returns in what? Take it out. What do you have? This. So this is what you have here. You less your cost of goods sold. Note 2. Take it out. How do you get your cost of goods sold? You have note 2 here. Opening stock. Add purchases. Carriage in what is added, less return outward. You have this. Then you less carry closing stock to get your cost of goods sold, right? So this is it. That is what you have here. Note 2. Note 2 is showing how you have your cost of goods sold. Then you take out your cost of goods sold from your turnover. You have your gross profit. If you have other income, note 3, other income, discount received, investment income. When you add it, you have this. Okay, so this is your other income. You add this to this, you have your gross income. So less your total expense. What's your total expense? Rent, warehouse, salaries, discount allowed. So all the expense items, you group them, add them together, you bring them here, and then take it out of your gross income to have your net profit or loss. So basically, this is how you prepare your company income statement. But if, for instance, it is not a trading company, so you have just your turnover to be the income items, and then you have your your expenses, then you get your profit or or loss. Now, as a company, it is very possible that after making a profit for a particular period, you use it to you spend that profit in a particular way. For companies, this is approved or decided by the board of directors. So board of directors will determine how the profit made in a particular period is utilized. So it is possible that when they make a profit for a particular period, out of the profit, they pay shareholders. What do you pay shareholders? You pay them dividends. You pay shareholders dividend. So dividend is paid. It's possible they want to write off goodwill. It's possible they want to pay preference shareholders, okay, interest. It's possible they want to put some money in reserve for growth and all that. So basically, the way they will utilize that profit as decided by the board of directors is shown in the company appropriation account. So what we have there is profit made and then how it is utilized. So this is what I'm saying. Profit and loss appropriation account. We have profit brought forward. This is it. Profit for the year. This is it. So when you add them together, you now share it according to what the board of directors have decided. They can say, okay, let us pay ordinary shareholders their dividend. You pay them. Let us pay preference shareholders their dividend. You pay them. Let us write off goodwill. You pay them. Let us pay preliminary expenses. You pay them. Let's take some to capital reserve or whatever reserve they call it. You pay them. So by the time you pay all this or take all this out of the profit, whatever is left is what we call the unappropriated profit or undistributed profit. So basically, you made a profit, you had a meeting with the directors, you agreed to spend it in this way. So whatever is less is called the unappropriated profit. Now we have company balance sheet. The balance sheet of a company is the same thing as statement of financial position. Okay, so what you are trying to show here is the company's assets, the company's liabilities for the period. But in a balance sheet of a company, you have other items like reserves. What are reserves? The company can say out of the profit, let us keep some for somewhat specific purposes. So you have that reserve there. But you're still showing your assets and your liabilities. But the capital of a company, we have shares. We call it share capital. You can have various share capitals. You can have ordinary share capital. You can have preference share capitals. Ordinary share capitals are shares that are owned by the real owners of the business. Okay? They are the loss or what we call those that the liability, those that take liabilities for for the business in event of what? Of maybe winding up and all that. So they are more like the loss bearers of the what? Business. There's also have some liabilities, but they are treated with some preferences. So if you have to make some payments, the preference shareholders take before the ordinary shareholders. That's basically the idea, but they are all shareholders, and the shareholders are shown in the balance sheet. So basically, this is how a company balance sheet looks like. Okay, you have statement of financial position at the 1st December 2018. Your balance sheet is your normal balance sheet. I've told you how to prepare that, but we just have some slight adjustment. You still have your non-current asset, which is your fixed asset. You have your notes here showing how you got your non-current asset. So let's go. What are the things that make up your non-current asset? You have land and building, motor vehicle, office equipment. You can have other things, furniture and fittings, equipment and all that. So when you add them together, net of depreciation, you have this. You have other assets. Note 6 here, goodwill, patent, copyright, and other intangible assets. You have them here. You add them, you have this. When you add it together, you have this. Current assets, okay? Cash at hand, debtors, prepaid expense, accrued incomes, closing inventories. When you have all those items, you pull them here, you add them together, that's your current asset. When you add this, when you bring this down, you add this to this, you have your total what? Asset. Now, your total asset, how did you finance it? You have liabilities. You know what liabilities are already. If you have issues with that, go back to our classes for liabilities. Double entry for liabilities, you understand. So long-term liabilities are liabilities that what you pay over what a long period of time. So basically, we have the debentures. Okay, it's an arrangement where you raise money for business. You have bank loans. When you add together, you have this. Okay, so the next one is short-term liabilities. You have 9 here. What are short-term liabilities? We have creditors. We have bank overdrafts. We have proposed dividend. Proposed dividend is the dividend that you want to pay shareholders, but you are yet to pay them. So basically, you are owing the shareholder. So when you add them together, you have your short-term liabilities here. So that's it. When you add this, you have this. Then we have reserves. How did you apportion your profit? Okay, so you took some to capital reserve, and then the one that is undistributed, that is after taking out those what other items. Okay, then you have what undistributed. So if for instance you made a profit of 10 million, out of the 10 million, or let's say 10 million, out of 10 million, maybe you paid dividends 1 million, you paid interest on preference shares another 1 million, that's 2 million, you have 8 million left. Maybe you wrote off goodwill 3 million. Okay, that's 5, you have 5 million left. Let's say you now paid preliminary expenses 2 million, so you have 3 million. That 3 million that you have, you can say, okay, let's take what 1 million to capital reserve. The remaining 2 million is undistributed. That's what you have here. So basically, you add it up to your reserve, and then you bring your reserves here. Okay, so that's what you have here. Then we have authorized share capital. Then we have preference share capital. They are all share capitals, but preference shareholders have preferential treatments. Ordinary shareholders are more like the loss bearers of the what? The equity holders of the what? Of the business. So when you add together, you have this. So when you add this to this to this, you have total what? Liabilities must be equal to your total what? Assets. Okay, so let's look at a question on preparing company income statement and balance sheet. Okay, so this is not a typical trading profit and loss account that you know, because I've already taught you that. So taking a slightly different approach, but it's the same thing. Okay, so let's go. They say the following trial balance has been extracted from the books of XYZ Nigeria Limited. Okay, an authorized share capital of what? With an authorized share capital of what? 2 million ordinary share at 1 naira per share. You have to prepare the income statement and balance sheet. Okay, so this is the trial balance as at 2010. Okay, so what do you have? We have sales. This is the sales. Sales here, 2.8 million. We have profit at 2009, 365,000. We have directors allowance, or we have rental income 520,000. So we have directors allowance, we have rent, traveling, training and development, salaries, vehicle, land and building, furniture, office equipment, debtors, creditors, bank overdraft, cash at bank, motor vehicle. We now have 900,000 ordinary shares, 1 naira worth each. 1 naira per share, that's 900,000. Now I have 326 preference share at 2 naira per share, 652,000. So this is a trial balance, but they now give us additional information. They said directors propose 10 kobo dividend per share for ordinary share and 50 kobo for what? Preference share. So that means the preference shareholders are paid 50 kobo per share. The ordinary shareholders are paid 10 kobo per share. So the next one we have here is accrued rent as at 31st December 2009. So sorry, it's accrued rent as at 31st December 2010, not 2009. So that has been rectified. So we have directors also agreed to reserve half of the profit after dividend for what? Growth. That's like capital reserve. They are now saying depreciate all assets except land and building at what? 20%. Okay. Now this is the question. So we have to prepare the income statement and the balance sheet. What's your income statement? That's more like your profit and loss. What are your incomes and what are your expenses? So let's go. We have XYZ Nigeria Limited income statement for 31st December 2010. Income statement for 31st December 2010. So we have what? The income here, note 1. What are the makeup of your income? This is your note 1, incomes. We have sales. This is the sales, 2,800,000. Okay. Then we have rental income. Rental income is 520. So when you add 2,800,000 plus 5, you have 3,320,000. That's what you have here as your income. So what are your expenditures? Note 2. These are your expenditures. So let's go. What are they? The first one is director's allowance. Is there any information on director's allowance? We'll come to additional information. No information. So director's allowance is 252,000. The next one is what? Rent, 398,000. Is there any information on rent? Yes. Accrued rent as at December 2010 is 95,000. Remember, I taught you accruals and prepayment. So go back to the class on accruals. I told you accrued expenses at the end of the reporting period is what? Added to the what? Amount paid for the year, and the accrued rent itself is a current what? Liability. So basically, we have rent here to be 398,000. We have accrued rent to be 95,000 at the reporting year. Reporting year is 2010. At the end of reporting, so we say rent 398,000 plus 95,000. That gives us 493,000. The next one is traveling. Is there information on traveling? No. So we take it straight, 280,000. Training and development, 355,000. Is there information on training and development? No, we take it straight, 355,000. Salaries and wages. Is there any information on salaries and wages? You check. No information. 395,000. Okay, we have vehicle repairs, 85,000. Any information on vehicle repairs? No. You put it there straight. Now, what other expense do we have? I think that's about it. But we have depreciation. They said depreciate all assets except land and building at 20%. Okay? So what's the first item there? We have furniture. What are furniture and fittings? 270,000. 20% of 270 is 54,000. That's 0.2, or 20 divided by 100 times 270. That's 54,000. The next one is office equipment. Every equipment is 750,000. 20% of office equipment is 150,000. The next one is motor vehicle, which is, how much is motor vehicle here? 950,000. 20% of 90,000 is 190,000. So you have all your expenditures. You add everything, you have 2,254,000. That's what you have here in note 2. Take this out of 3,320,000. You have 1,066,000. That is the what? Profit you made for the year. Okay, so let's now appropriate. We have made the profit. So how do we share based on what directors have approved? So we have appropriation account at first matter and 10. Profit brought forward 365,000. Look at it in the question. That is the profit they made at the end of 2009. That's what you have here. Profit for the year. Look at it here. 2010, 1066. Okay. Now, how did we share it? Look at what they said. They said we should pay. Directors proposed 10 kobo for dividend for ordinary share, 50 kobo for preference share. So preference share is what? 50 kobo. How many shares do you have? Look at the question. It says 326,000 shares at 2 naira per share. So 326 shares. So one share is what? 50 kobo. 323,000 shares will be 163,000 naira. Okay. So we have ordinary dividend. What did they say? Director said propose 10k dividend for ordinary shares. Okay. So we have ordinary. So how many ordinary shares do we have? We have 900,000 ordinary shares. So we have 10 kobo, which is 0.1 times 900,000. You have 90,000. That's for ordinary dividend. They are now saying, they said directors agreed to reserve half of the profit after dividend for growth. Okay. So basically, when you add this to this, you have 1,431,000. Take out 163,000. Take out 90,000. You have 1,178,000 left. They are now saying half of it should be reserved for growth. So let's say capital reserve. So we have 1,178,000 divided by 2. That's 589,000. So the rest is what we call the undistributed profit or unappropriated profit. So you have 143, 100, 143, 1,000. Okay? So we've done that. So let's prepare the balance sheet. So basically, what have we done? We have prepared the income statement. So from the income statement, we derive the what? Profit. So we now took the profit to what? Appropriation account. Add the profit from the last year, and now we now divided it or apportioned it based on what the board of directors would agreed. They agreed to pay preference dividends, 50 kobo per share. They agreed to pay ordinary dividends, 10 kobo per share. They agreed to take what? Remaining profit, half of it to capital what? Reserve. And that's what we have done in the what? Appropriation account. So the next one is to prepare the balance sheet. So we have XYZ Nigeria Limited. Turn of financial position as at 31st December 2010. You can also call it balance sheet. Okay. So we have non-current assets. What are non-current assets? Fixed assets. So what makes up your non-current assets? Look at it here. Okay. Land and building, 1,302,000. It's in the question. Look at it. Land and building, 1,302,000. Okay. The next one, furniture and fittings. You have it as how much? 270,000. Remember, there was a depreciation on furniture and fittings. Look at it here, 54,000. So you report net of depreciation. So furniture and fittings will be 270,000 minus 54,000. That will be 216,000. Office equipment. What was in the question? 750,000. So there was depreciation of how much? Of 150,000. So office equipment will be 750,000 minus depreciation. Look at depreciation here. 150,000. Office equipment, 750,000. 750,000 minus 150,000. That will give us 600,000. That's what you have here. Office equipment, 750 minus 150, 600,000. Motor vehicle is how much? Motor vehicle in the question is 950,000. What's depreciation? 190,000. So we have motor vehicle 950,000 minus 190,000. That's 760,000. Okay. So 1,302,000, 216, 600, and 760 will give you 2,878,000. Okay. So that is your what? Your non-current assets. That's what you have here. 2,878,000. Okay. The next one now is your current asset. What are your current assets in the question? You have cash at bank, 100,000. Debtors, 350,000. So when you add together, you have 450,000. Okay. So that's what you have here as current asset, 450,000. So when you add this to this, you have 3,328,000. That's what you have as your total asset. So how did we finance the assets? We finance it with what? Short-term liabilities. There's no long-term liabilities. What are the short-term liabilities in the question? You have what? You have debtor. No, you have creditors. Okay, that's creditors. 100,000. You have accrued rents. 95,000. I already explained that. You have bank overdraft in the question. 150,000. Remember, you have proposed to pay preference dividends. You have proposed to pay ordinary dividend, but you have not paid it. So that means you are owing the shareholder. So they say short-term liability. So we have preference dividend 163,000 based on what we got in the appropriation account. Look at it here. Ordinary dividend the same thing, 90,000. So when you add together, you have 598,000. So the next one is your reserve. What are your reserves? Remember, we said we are taking half of the profit after dividends payments to what? Capital reserve. So we have capital reserve here, 589,000. Then the undistributed profit, which is also a reserve, will be there. So total is what? 1,178,000. That's what you have here as the what? Reserve. So when you add this to this, you have 1,776,000. Now, what is your capital? Your authorized share capital is 2 million ordinary share at 1 naira each. Just state it for the purpose of it. But your preference share, which has been issued from the question, preference share is 652,000. Ordinary share is 900,000. So when you add together, you have 3,328,000. So that's this plus this plus this. 1,776,000 plus 652,000 plus 900,000. You have 3,328,000, which is your total liabilities, which is also equal to your total asset. That is what is showing the position of the business as at 31st December 2010. In this class, we've been able to show illustrations on how to prepare accounts for companies. Basically, we concentrated on what? Company income statement, company appropriation account, and the company's what? Balance sheet. We're also able to explain that companies can operate in various industries, from finance, services, to petroleum marketing, to transportation, okay? And then we were able to explain the basic income items for this other industry, taking examples of some companies in Nigeria. We also give an illustration on how to prepare the income statement and the balance sheet. So I will encourage you to go through the class on your own. If you have questions, you can reach me on 08136506356 or send me an email, jeremiah.dosu@gmail.com. You can drop questions in the comment section. I'll be there to reply you with the right answers. If you have questions as well, on my Facebook